Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons of wealth creation and also have a chat with you about any of your questions that you have. Click the link below and send us your questions so we can get you on the show and get you working towards your wealth creation journey. Now today, I want to have a chat with you about capital gains tax, the dreaded CGT, the thing that we all hate paying when we sell an asset and we've made some really good decisions, made the money, and then we've got to share some of that profit with the Australian Taxation Office. This is a topic that comes up all the time with all my clients. Now, as an accountant in this space, I'm dealing with capital gain tax calculations and conversations on a daily basis. As an investor myself in property and in shares, it's something that I always look to minimize. And today I'm going to chat with you about some of the strategies that we can implement, some of the structures that we can use, and some of the theories that are out there to help you minimize your capital gain tax and make as much of that money stay in your back pocket as we possibly can.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
So first, I'm just going to start with what is capital gain tax. Capital gain tax was really brought in, and there's a cutoff date for it, for any assets that have been purchased and owned post-1985. Now, really, what we need to talk about is, well, what type of assets are included in the capital gain tax calculation? It's any asset that we've gone into where the sole purpose is to derive an income, maybe not now, but well into the future. Now, there are some exemptions to capital gain tax, and we'll touch upon that later on. But firstly, what is it? Capital gain tax is a tax that we pay on the income that we earn that's been generated from the investments that we make post that 1985 date. So that includes properties, it includes shares, it includes some collectibles, it includes gold, it includes silver, and there's some rare exceptions to the precious metal capital gain tax calculation. And yes, for anybody that's out there, it does include cryptocurrency as well. Although there are some minor exceptions to the cryptocurrency capital gain tax calculation, and it really goes towards, well, what are you using that cryptocurrency for? Are you using it for the purchase of goods and services? If you are, there are some limits that apply, which is roughly to the sum of about $10,000. But for most cryptocurrency bulls that are out there, really it's for a capital gain purpose. So be mindful of that capital gain tax that you need to pay. Now, there are rules, again, from a 12-month exception and an under 12-month exception. If we do hold an asset and we do sell it within 12 months, we pay capital gain tax at our marginal rate or at the structures rate. And if we do hold that asset for more than 12 months, we do get a 50% discount, essentially meaning that 50% of the profit that we make, we get to keep in our back pocket, which is really good. And the other 50% gets added to the income of ourselves, being the marginal tax rate payer, or the structure. Now, I want to talk about minimizing capital gain tax. There are some really good, not theories, but strategies there that you can utilize to minimize your capital gain tax. And the first one is try to hold the asset for longer than 12 months. Depending on the structure that you invest in, holding the asset for longer than 12 months results in a 50% capital gain tax discount. And that means 50%, as we mentioned prior to this, goes in your back pocket, and the other 50% gets added to your taxable income, which you pay tax on. There's windows of opportunity where you can sell those assets to minimize your capital gain tax, such as selling those assets at a time where your income is at its lowest point. So for instance, you might be a full-time employee at the time of acquiring these assets, and then you might decide to take a couple years off work if you're one of those lucky few. That would be a really good time if you were thinking of selling the assets to do so, because that is when your income is at its lowest point, and therefore the marginal tax that you pay on 50% of that profit if you've held the asset for longer than 12 months is also at its lowest point as well, essentially saving you money. You've also got the ability to time certain levels of deductions. For many property investors that are out there, they try to potentially prepay expenses such as interest or other costs. There might be some of those genuine repairs and maintenance that are not depreciable in nature, which gives you an opportunity of also reducing the income as well. And we've also got the ability of contributing to super, especially using the 5-year brought forward concessional rule, which allows you to go back and top up all those other years that you haven't reached the concessional cap of $27,500 or $25,000, depending on their respective years. So it's a really great way to minimize your capital gain tax. I suppose inside the minimizing your capital gain tax rule also comes structures. How you structure your asset will depend on how much tax one can potentially save. So for instance, if you are in a corporate entity or a company, for instance, a proprietary limited entity, generally companies do not receive any 50% capital gains discount. There are some exceptions to this rule. There are 4 different rules that people utilize when selling businesses, like active asset reductions, but that's a topic for another day. Today, we're just really talking about hard assets like property, shares, collectibles, precious metals, and other things like cryptocurrency. So keep in mind, a proprietary limited entity for most cases will not result in a 50% capital gain tax discount, which means you're really paying 25% or potentially 30% on the gain that you've made on the sale of that asset. For instances like trust, they do get a 50% discount as long as they pass through the distribution to a beneficiary that's receiving the 50% discount. So for instance, like an individual tax rate payer, so a mum and dad for argument's sake, and that's going to give the ability, if you are in the right trust, for instance, a discretionary trust, to be able to really pick and choose where that capital gain goes to and to the beneficiary with the best tax rate. You might be in a unit trust where unfortunately the units are fixed, therefore the distributions are fixed. It doesn't give you sometimes the right amount of discretion to be able to distribute the profits, but nevertheless will give you some ability to minimize tax. If you're in a superannuation fund, now this is the real fun bit about super. If you do hold an asset for longer than 12 months in superannuation, you do get a 1/3 discount. So essentially meaning 33.333 as long as the eye can see. That is discounted from a capital gain tax bill. And that means really remaining the other 66.66, again, as long as the eye can see, is subject to capital gain tax at a 15% tax rate. Because remember, in super, earnings are capped at a tax rate of 15%. So essentially what that means is that the capital gain that you've made in super, the effective tax rate on that capital gain is 10%. $100,000 profit that's been made on an asset that's been acquired and held for longer than 12 months, $33,333 is exempt for tax, great. And the other $66,666.00, as long as the eye can see in the number of sixes, it's going to be applicable tax at 15%, which effectively means we've got $10,000 in tax that we pay. $10,000 on that $100,000 investment is an effective tax rate of 10%. So structures do come into play when trying to minimize capital gain tax. So we spoke about superannuation. We spoke about timing of deductions. We've spoken about how structures form to minimize capital gain tax. Let's talk about some other more regularly used rules. In the property space, there is the 6-year rule. The 6-year rule was really brought in for those people who were living in their principal place of residence and had to move outside for work purposes or potentially overseas and a secondment. And what the tax office and the government allowed them to do was still nominate their principal place of residence for tax purposes as their PPOR for a period of 6 years from the time that they moved out of it. Now, that effectively meant that they needed to move back into that property within 6 years to reset the period, or they had to sell the property within 6 years and they'd be paying no capital gain tax on that particular investment, even though they rented it out for, say, an instance of 4 or 5 years. So the 6-year rule is a very important rule that you need to review, especially if you're moving out of your own home and renting somewhere else, moving back in with parents, or potentially being seconded for an employment role. The trick to it is, though, you must not nominate another home as your principal place of residence, effectively meaning if you've bought another home and you decide to move into it and nominate that as your PPOR, you do lose the 6-year rule on that first property as a pro rata basis. So that means for the period of time that you did not have another home as your PPOR. Now, there are a couple of exceptions to CGT, and there are some things that many people do miss, and that is the importance of establishing a cost basis. Now, one of the biggest things that I see with not only my clients, but many questions that I do get is, Jeremy, how do I calculate my capital gain tax? What are the costs and the functions that go into the calculation? And establishing a cost basis is so important. It's knowing what are the costs or what were the costs involved when you purchased that particular investment. So for argument's sake, what was the cost of the share that I purchased? What was the brokerage fee that I paid? If I were in a dividend reinvestment plan, meaning that dividends were paid, but rather than coming to me as cash, they were used to purchase more shares, what was the cost at which those shares were purchased at. So establishing your cost basis is one of the most important things. That sets the foundation to then calculate your capital gain on the sale when it's made. From a property perspective, it's identifying what were the functions of cost. We have our purchase price, our stamp duty, our solicitor fees, and other auxiliary costs, which may be, for instance, settlement charges when you've purchased it and sold it, marketing fees, agency fees, PEXA fees, even solicitor fees when you sell it. There could be some renovations that you did to the property when you first bought it. They all form part of the cost base, and it's an essential part in minimizing your capital gain. So many times I see clients lose their paperwork, or they haven't summarized the information they needed to when they first acquired the investment. So many times I see a lot of this being missed, and it does result in additional capital gain tax that's being paid. So establishing your cost basis is so important. Other people call it estate planning. I do that with my own personal portfolio. If I was to drop off the face of this earth, my wife and my family do have all of the established cost basis for all the investments that I've got. And what that gives them is the clarity that when they do sell an investment, and I'm not here to tell them what the cost basis is, they've got this beautiful estate plan that I've put together. And that will help them make decisions of minimizing the capital gain tax that the people that have inherited my assets will have to pay. So it's so important. I really urge anybody that's out there, do your own basic estate planning. Get your cost basis being established. Identify where your assets are, what structures that you've got, where the asset's invested in, whose name's it in. The more information you can give the next generation, the better tools they'll have to be able to minimize the capital gain tax if and when into the future. Now, the big one is inheritance. This is a topic I speak with people daily about. We're not on this earth forever as long as we'd like to think, but nevertheless, inheritance is a major form and part of people's wealth. It's the generation before providing to the generation to and subsequent as well. So inheritance becomes a major play. When you inherit an asset, in most cases, it could be the family home. You've got up to 2 years to potentially sell that asset before you need to pay any capital gain tax. And that's on the basis that the family home was never used for producing income. If you decide not to sell that family home within that 2-year basis, you do need to do a valuation on that home at the passing of the person who you've inherited it from. So important. You need to do a valuation at the time that the person passed so you can establish a cost base. And that way, it's regardless of what that person may have bought that property 10, 20 years ago, your valuation now becomes your new cost base, and you will only pay capital gain tax on the increase of that valuation price. So very important. Now, you may have had a person who bought that property or investment prior to when CGT came into implementation. That means that, again, a valuation needs to be done to establish that cost base at the time of the person's passing. So we don't necessarily get the tax-free status moving forward. That was only for the person who, unfortunately, in this particular situation, passed away. And I'll give you a very good example. Sally bought a property in 1970 for $10,000. Believe it or not, for $10,000. She passed away now in 2023, and that property is now worth $2 million. Now, if Sally sold that property prior to her passing and she bought that pre the CGT rule coming in, she would be paying no capital gain tax. Unreal, brilliant. But now Sally, through her will, she has passed on that asset to her son, George. Now, George has the ability to do a valuation on that investment property and therefore establish the cost base at $2 million. And what that does do is it gives George the assurance that when he sells that property in many years to come, say for argument's sake for $2.5 million, he will only pay capital gain tax on the $500,000 uplift. So it's so important to, again, establish your cost base and know when that property was bought. Now, another common question I get is, Jeremy, it's now 12 months post the person's passing. What do I do? Very open. You can get a valuation being done in retrospect. Now, it needs to be a registered valuer. Unfortunately, in most cases, a real estate agent will provide you a market appraisal. A market appraisal is good for gaining what the market is doing, but it won't be considered as a registered valuation. A registered valuation needs to be done by a registered valuer who's affiliated with a body. or an industry body. So you can get a valuation done in retrospect. It's better to do it sooner than later. The reason why, because part of the conditions of doing a valuation is you need to be present in market conditions. And again, the longer that you leave it, it does become a little bit tougher, and the valuer will note that in their valuation report. So it's important when you're inheriting an asset, especially if it's a family home and you decide that you want to keep it for the long term, get a valuation being done. That's going to help you establish the cost base and then give you assurance moving forward in the future of what your capital gain may look like. And this is a great way to minimize your tax. Again, if it's an investment property for someone who purchased it prior to CGT being calculated, a valuation is important. And if it's an investment property that you've inherited or shares that you've inherited, for argument's sake, post the CGT date, then unfortunately what happens is you inherit the cost base of that share and you essentially pay tax later on when it's sold, either A, when it's passed to you, or the estate must pay capital gain tax on that sale. So getting people to establish the cost base is important. So running through just the CGT minimization again, structures becomes a very massive play. Timing of expenses is a very important rule. The CGT establishing of cost base is important, knowing if it's pre-CGT date or post-CGT date. And when you are inheriting a property, it's really important to make a decision very early on if you're A, going to be keeping it and therefore getting a valuation to be done to establish that cost base as we initially said, or B, if you are deciding to sell it, I think selling that within inside the 2 years is ideal, and that way it still remains a capital gain tax-free sale. So I hope that you've got a lot out of it today. We've touched upon many different CGT points. And again, everyone's situations are quite unique and very different, and you should be seeking help or assistance from the professionals around you. This is what school should have taught you. And please, if you have any questions, do send them in, and we could be chatting with you here on this show to help get you moving forward in your wealth creation journey. I'm Jeremy Iannuzzelli, and I look forward to seeing you next week.